Hello, and welcome to Inderes TV. Today I'm in the studio with Analyst Pauli Lohi to discuss Hexagon's Q2. Hi Pauli, and welcome.
Hi Pia.
So let's start with the tops and flops of Hexagon in Q2.
Well, generally Q2 report was a bit weaker than expected by consensus or us. Growth in general was weaker. I think sales missed our estimate by 3% and growth was 4%. That's points lower than expected by consensus. So that was the major thing. And then if you look below the actual sales, there was still quite good profitability in Q2. It was driven by recurring revenue that grew very nicely by 8% year on year. So products like software and services grew well, and I think that the underlying development in the company was pretty good. But the cyclical components in certain divisions, maybe linked to construction sector and automotive industries. So those were which burdened the headline growth.
Okay, so in the report we can see that hardware sales was a disappointment. Is this something we should be concerned about in the longer term?
Well, I don't think so. There is cyclical components in Hexagon, and there has always been their relative share of the revenue has been declining over time because the share of recurring revenue has increased. But there is still, I think, some 40% of the revenue is coming from hardware sales. So that will always be somewhat cyclical. And now we are just seeing that the cycle has turned so much negative that it actually pushes the total growth to zero, where there is software and services growing and then hardware negative and
it pushes
total. It was pretty much zero growth.
Okay, and as you said, recurring revenues grew, and this is probably a trend that we can expect continuing, the positive trend on that side?
Yes, I think so, because over long term, for example, in the past 15 years, the share of recurring revenue has grown significantly and is already close to half of the company's revenues. So this is the long-term trend. It has of course been partly driven by acquisitions of software companies, for example, increased demand for SaaS subscription models and so on. So I think that this 8% growth in recurring revenue we saw in Q2, it's quite high. Probably it could maybe moderate a bit over long term, but I still expect growth.
Yeah. Right. The company stated that it continues to focus on improving the sales mix and cost savings. What types of moves are you expecting during H2 on this front?
Well, this recurring revenue that grows better than other streams, it is more profitable. It has high gross margins, especially software and SaaS. So that's driving the gross margin up. Of course, also new hardware products, they usually have better margins than the old products. So that's also another driver for the gross margin. And then if you look the fixed costs, they have this regionalization program they kicked off 1 year ago. And now they have reached almost fully the savings target on run rate basis. So going forward, that will definitely help the profitability. And also, if you look the comparison figures from last year, I think it also becomes easier to get earnings growth if you go to the second half compared to first half.
Right. Okay. And as you mentioned, they are planning new product launches already in Q3, I understood. So do you have any thoughts about what kinds of product types? You said hardware, but anything else you're expecting?
I expect both software and hardware. In the software side, they have launched 2 significant platforms in the past years. These new platforms will get more content in them because there's already a big number of users using them. But new modules, new content to these platforms will drive growth. Then in the hardware side, I think I don't have any specific like clue what new products are coming, but I think that probably reality capture, industrial metrology, or autonomous solutions are some areas that could be.
Okay, interesting. So for the rest of this year, what are your expectations? Are there any signs of a pickup on the market?
Well, if you look to the rest of the year, we don't see the cyclical components improving yet. So that's important to acknowledge that there is no like silver bullet coming in the remainder of this year. But however, the comparison figures get much easier.
Yeah.
So because there was already weakness in the latter part of last year, so that will help the relative growth figures and also improving the earnings. I expect zero growth to continue in Q3 and then some step up to some 4% in Q4.
Okay, so a slight improvement towards the end of the year then. What about the longer term next year and maybe further? What's your expectations or outlook for that?
Yeah, Hexagon is quite diversified company with several business segments, which makes it very stable, and also the share of recurring revenue. So it's a stable company. If you think about long term, it has grown some 5% per year organically, which is pretty nice. And then there is this cyclical fluctuation. Now we are seeing the more negative effects coming from that. But in the history, those have usually been quite short periods, and then there has often been a rebound after that. So I believe that the growth could get back to the 5, maybe even 6% in the 2025 and 26. And well, one good indication is that these non-cyclical components are growing so fast that even if cyclical components will moderate, that will push the growth positive.
Upward, yeah. So stable growth expected going forward after this year.
Yes, and then the efficiency program benefits will be fully visible next year.
Of course, yeah. And then finally, what about the valuation recommendation? What does that look like?
Well, this is highly profitable, rather stable and growing company. So I think one should own this in the long term. So like usually you should own Hexagon share, but we have been a bit cautious so far because high-ish valuation and then these cyclical concerns. So now investors are actually seeing the cyclical concerns hitting the fan. So now I think the risk-return ratio has turned more attractive, and the stock price has came down a bit, and at the same time the development, the underlying development has been good in the company. So there's been cost savings, there's been growth in high margin products and recurring revenue. So I think it has become more attractive, and historically these weak periods have been short, and there's been rebound afterwards. So I cannot say that it can't get any worse than this, but I believe that this is a good moment when the risk return ratio is favorable. If we look to the valuation, it currently trades somewhere around EV/EBIT 17 on adjusted terms. Historically, it has been more close to 20, but we believe some 18 could be fair level. That's our view, and with that valuation, we derive our target price of 115 Swedish crowns. So we are currently with the accumulated recommendation, and we believe that this cyclical weakness could provide a nice opportunity for investor.
Yeah, so it might be a good time to buy, and for a long-term investor, keep the share.
Yeah, exactly.
Thank you, Pauli.
Thank you.
And you can read more in the report that you find at inderes.se.